Hi, everybody. Chris Englebert with Englebert Financial Advisors with the weekly QDEC update. You can see it's the first of the month, and we are going to be talking about the December investment strategy update. I always start out with a cartoon. You can see this cartoon happens to dovetail into Thanksgiving, was just passed last week, and you can see that everybody's bearish out there. And what I mean by that is that if somebody's bearish, they think the equity markets are going to go down. If somebody's bullish, they think the equity markets are going to go up. So let's do a little review of what's been happening so far the last couple of months. We had a bad month of September. The stock market, the S&P 500 was down 9.32% for the month of September. But then literally when we got into October, we had a really nice rally of almost 8%. And so far for November, we have about a 4% rally in the S&P 500 as well. So why did we have such a good rally? Well, people are beginning to look at earnings going into the fourth quarter, and the earnings were not bad. In fact, they actually came out better than expected for many of the companies out there. There were some revisions higher, and we saw an overall better positive tone to the market. Now, we've only got about 4 weeks left until the end of the year. The S&P 500 is down about 16, 17% for the year. The question is whether or not we're going to get a furious December rally to get the S&P 500 to close only down single digits for the year. A lot of the market pundits are coming out and saying that we're extremely oversold and that the bearish sentiment out there lends itself to a surprise on the upside. I do agree with that. The question is, it's going to happen in December or is it going to happen in January? We have a lot of important economic information coming out. We have Chairman Fed Powell speaking this week. We also have the unemployment numbers coming out at the end of the week. And next week, we have the all-important CPI numbers, which are going to show whether or not the economy is cooling. Now, let's take a look at the bond market, because the bond market and the dramatic rise in interest rates have really been driving the decline in the stock market this year. And you can see by my chart that just about early October, mid-October, the 10-year Treasury peaked at about 4.25%. And since that time, it's fallen back to 3.75% on the 10-year Treasury, which really is due to the fact that the CPI number that came out last month shows that inflation is cooling off and that the Fed may be closer to the end of raising short-term rates than they are obviously continuing to raise rates. Now, one of the other things you got to take a look at is that we're seeing CD rates out there that we have not seen in 8 or 9 years. Right now on 3, 4, 5, 6 month bank CDs, you can get over 4%. So if you have a lot of cash sitting in a money market fund, not doing anything, and you're too afraid of the bond market and too afraid of the stock market, CDs are offering an opportunity that we haven't seen in a long time. But let me talk about the investor sentiment again. And this has been the overriding theme this year on how negative people are. This particular chart here shows you that there are what's called inverse equity funds out there. And what I mean by that is that these are funds that if you buy and the stock market goes down, they go up in value. So you have investors that are saying, I'm going to make a bet that the stock market is going to go down, and they buy a lot of these inverse funds. Nothing wrong with that. You're buying some insurance, and we run a couple of strategies where we use a portion of inverse funds to offset the volatility. But take a look at this chart. The red line shows investors buying inverse funds. And back in 2008, 2009, you can see that inverse funds were huge. People were betting the stock market was going down. We had a global financial crisis happening. And lo and behold, look what happened when everybody bought inverse funds. The stock market started to take off on the upside and really accelerated. Well, now look at the right-hand side of this chart, and you can see again that so far this year with the decline in the stock market, people again are making huge bets by buying these inverse funds. And one of the things that I've learned in my long tenure as an investment advisor is that when everybody is super negative or everybody is super positive, you usually want to take the other side of that trade. So let's wrap it up. But before I do that, I want to talk a little bit more about the inflation numbers that we're going to see here. And I'm showing you a chart of oil. And this is very, very important because oil started out the year at $75 a barrel. It went all the way up to about $125 a barrel during the Russia-Ukraine invasion. And you can see that oil is basically back to where it started this year. So oil is one of the key components to inflation for not only oil prices and gasoline prices, but all the products that are made, the petroleum products that are made from oil. You're going to see a lot of those input costs come down and come down rather dramatically. And that argues our case that you're going to see inflation start to come back down, which means the Fed doesn't have to be as aggressive raising interest rates. So to sum it up, we had good third quarter earnings. It produced a nice recovery in the U.S. stock market. The big question is, are we going to get a Santa Claus rally in December? Again, I want to say the surprise is on the upside. If it doesn't come in December, maybe it comes in Q1 of 2023. We did have a cooler CPI number, which is good. We saw a large rally in stocks, a nice drop in bond yields because of that. But again, the overriding theme so far this year has been the negativity and the pessimism that we've seen in the stock market and the bond market. And people have high cash balances and they've placed negative bets. And once again, when everybody's on one side of the boat, usually you want to be on the other side of the boat. So what does this mean for you? You got to review your long-term investment strategy. So this year, bonds are down, stocks are down, and many times people say to themselves, I got to do something. I didn't make any money this year. Well, if you have a really good long-term investment strategy, don't change a thing. Some of the hardest things to do are just sitting on your hands and doing absolutely nothing if you've got a good investment strategy. However, if you've had some life changes, some things are going on, maybe you do have to dial back your risk, or maybe you want to make some changes as far as your portfolio goes. But again, most of the time, if you have a good investment strategy intact and you run into a negative year like we did in 2022, you don't want to do anything because, again, when the markets come back, you may have then zigged when you should have zagged. So that's all we have this week for this weekly update. We'll be back next week and we'll talk to you soon.